Wednesday, January 7th. Crazy snowstorm where I am. My internet's been a little wacky today, so hopefully you don't lose me. Um, because it is snowing. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure: I am out of my Intel swing long, and at one point I was actually massively shorted intraday, but that just turned into a day trade. And out of the WDC short, which I mentioned in the afternoon meeting yesterday, that was just a little small trade. I was out of that like when the market opened. I was out of that really quickly and did not go back to it. Right. So that's the position disclosure. Let's talk trading. Let's talk markets. So a little bit of a disappointment, I think, in how the market closed today compared to where we were at highs. So we opened up the day we opened up the day for the S&P around flat. We closed down 0.36% for the SPYs. The Qs were flat green. That's where the relative strength was today. And the IWM was down a quarter of a percent, but still looks very healthy on the daily chart. Looks more like a healthy digestion day. The RSP notably had a much bigger down day today. It was down a little bit over a percentage point. So it's kind of the quick index level update. As far as the charts go, so we can look at the daily chart in a second. The SPY daily candle is a little bit disappointing because we really tried to continue our breakout today in the SPY, and we actually closed below 690, which we don't want to be closing below 690 if you're bullish and you're looking for bolt continuation. So what that looks like here on the daily chart is, I don't know, is this a false breakout? Maybe. We'll see. We're still above all major levels, I guess, except for the all-time high. So this is not a market that by any means is bearish, but it did fail to really continue today. The Nasdaq had some relative strength today, and it's still above 620. But we had also been looking at this 625 spot 51 as like the real technical break of the wedge. So what you have now on that attempted of a technical break here on the wedge is a tail through it back down. So you don't really have confirmation that the Qs are breaking out to the upside like you would want to see. And the IWM took a little bit of a break today, but it was much needed. Three big up days in a row here for the Russell. Was moderately extended to the upside. Took a little bit of a rest day. Today's candle does no damage to the chart. So bottom line, though, is the SPY candle here is a little bit damaged. You don't love to see a push through failure. You really want to see us close on highs on a day like today. The Qs, it's still okay, but you don't love that tail through the upper band of the channel. Of the wedge. IWM is fine, and the RSP is okay. This is technically an RDR, by the way. We were looking for RDR examples yesterday. Got to above yesterday's high, so it was a day 3, really day 4. So 2 or 3 really big days in a row to the upside, getting the RSP moderately extended, and then you had a quick push through the previous day's high at the open and traded back down it. So the RDR trade, technically, just because we were talking about it yesterday, would be to short through yesterday's high with a stop loss at the day high, and it worked phenomenally well in the RSP. It also worked pretty well, but it executed pre-market in the XLF, and we had noted that XLF there was downgrades in I think Bank of America and JP Morgan both got downgraded today. So we actually called for a potential short in the XLF today as kind of an early RDR, not as much extension as you would like to see on that, but 2 up days in a row with the 2 downgrades. Maybe you could get a pullback in the XLF. And there's that pullback in the XLF that I think helped to bring down this RSP. So this year has been marked by, in some ways, rotation of the rotation, or reverse rotation, whatever you want to call it, where Mag 7 has lagged a little bit, and it's been the cyclicals that have really played ball. It's been the banks, things like that have just been really strong in pumping this market higher. And you can see it in the IWM, you can see it in the RSP, And then today it felt like some of those names which had gotten extended, some of those meme stocks that had, 3 big up days in a row were taking more of a rest, but Mag 7 was actually showing some early strength. And you could see like Amazon was trying to give like a big day 2, ended up giving a bit of an upside tail along with the Qs. Google at one point was absolutely ripping, and we talked about this Google for a breakout trade really for a few days in a row, but we talked about it again in the morning meeting today. So it was good. It was tricky to capture if you didn't already have it, but it worked out. It worked out pretty well. So you tried to see some back to normal rotation would be the way to kind of describe it. Back to normal dispersion of Mag 7 leadership and the other names just resting a little bit. But they couldn't close it good enough, in my opinion. And that's why you have that upside tail in the Qs. That's why you have this push-through failure here in the SPYs. So we'll see how this plays out. It's something to potentially take note of, but I don't think it necessarily breaks these charts yet. But should this be a false breakout that eventually leads to a break of 680 in the SPYs, then we'll have to change our thought process and things will look more bearish. So, it's always just an updating situation as the market presents new information to us. But at a certain point today at highs, we looked like phenomenally good for continuation. And now here at the close, it's kind of a disappointing close. As far as trading goes for today, Intel, which I mentioned already briefly, was a real big focus for me. I had been swinging Intel long with the $42 price target. I got out at 42, and then next thing I knew, this thing was extending so big that I was starting a cute short in a small way. I forget exactly where. I think it was higher than that. Starting a cute short. Actually, no, it was lower than that. I think I started a cute short like a little bit above 43 in this thing. So I was early in a small way, but it was above 44. I remember noting to you guys that the tape was really increasing in speed. And that's kind of an old school tape reading signal to be able to see that the volume is potentially giving some sort of like volume capitulation move. It's ideal when you have maximum volume at tops and bottoms. So, we really saw the acceleration higher through 44. The tape really sped up through 44. And that was the signal to kind of really size up in this thing. So, I started small at 43. The position was going against me, but got really, really big above 44. I think my best fill was actually 44 spot 56 on some size. High of the day is 44 or 57. And, caught this big pullback initially to the 80 MA on the 5-minute chart. So there's your technical correction on the 5-minute. Then you got a lower high that actually led to a technical correction on the 15, and then it drifted down even beyond that. For me personally, I was almost all out by that full 15-minute correction, and then I was all out of the short by this 12:15 downtick candle here. So Intel ended up being great for me on both sides. I'm not sure if that many of you guys were participating in the long, but it sounded like a few of you guys were trading the short with me, which was solid. Palantir trading up for some reason, probably on whatever Trump is saying. Let me just see what's going on here. We're just increasing the budget. All right, let me just read it out loud so I can read it for myself as well. From President Trump. After long and difficult negotiations with senators, congressmen, secretaries, and other political representatives, I have determined that for the good of our country, especially in these very troubled and dangerous times, our military budget for the year of 2027 should not be $1 trillion, but rather $1.5 trillion. This will allow us to build the dream military that we have long been entitled to, and more importantly, that will keep us safe and secure regardless of foe. If it weren't for the tremendous numbers being produced by terrorists from other countries, many of which in the past have ripped off the United States at levels never seen before, I would stay at the $1 trillion number. But because tariffs and the tremendous income that they bring, amounts being generated, that would have been unthinkable in the past, especially just 1 year ago during the sleepy Joe Biden administration, the worst president in history of our country. We were able to easily hit the $1.5 trillion number while at the same time producing the unparalleled military force and having the ability to, at the same time, pay down debt and likewise pay a substantial dividend to moderate income patriots within our country. Oh man. It's just the math isn't mathing on the budget stuff at all. Especially as I'm pretty sure we announced more tax cuts today on cars, right? Hold on, I gotta figure out what's going on with this Palantir. I have a Palantir position, so just gotta make sure I'm managing it properly. Yeah, math isn't mathing at all. This is just going to be absolutely and utterly ballooning the debt, but who knows if that actually even ever matters or not, because it's all paper. But anyway, back over to our charts. Do I have anything else? Intel, a lot of position management for me, in silver and SOXL, reducing those short positions in Google into that up move. Trying to think about anything else I really wanted to discuss for today's meeting. Last couple of meetings we had a couple pretty good lessons in there, and I don't really think I have anything. So I'll just turn it over to you guys, I guess. Turn it over to you guys for any questions. Let's see here. Sounds good, Tim. Palantir moving. Sandisk held up great. Yeah, Sandisk held up great. Kind of gave a day two. Yeah, the day twos are always tricky. Sandisk held up great. It was day one yesterday, whereas like WDC gave an inside day today, gave a much deeper pullback. Bill K saying Sandisk holding up was sort of surprising. I would actually argue that I'm more surprised at the percentage of yesterday's move that WDC retraced than I am at how well Sandisk actually held up. It's a pretty big percentage retracement, even though it's an inside day on the Sandisk. STX maybe a little bit more normal of an inside day there. From Emily. Goldman Sachs on the daily chart, almost an RDR, but not quite yet. Technically, it's not. Well, technically, it wouldn't be anyway because yesterday was an inside day. So it's okay to hold it for a swing long. If you've got good pricing, if you have good pricing on this, then yeah, I would continue to hold it. You want to be long from the breakout, so you want to be long from somewhere between. I mean, Goldman's a tough name to trade because it's so expensive and the spreads are so wide. But it's like somewhere if you're long from somewhere between like 913 and 920, I think that Goldman is you got great stock and that you would continue to hold that. Otherwise, if you don't have good pricing, then you got to manage your risk accordingly. It's still a bullish chart. It was extended. It's pulling back. There's a good chance that this builds out a bull flag here. That's what I would say is the most likely situation. But it could fall down. It could just immediately work. So, as long as your pricing is good, you can continue to hold it for a swing long. If your pricing is not good, you just got to make sure that you're managing your risk properly because, this thing could pull back to 920 easily and still be healthy, by the way. So if you're long from, let's say, 950 and you're like, oh my gosh, if it pulled back to 920, I'm going to have a big problem. You just got to recognize this thing could pull back to 920 and still be healthy and bullish. So that's why, having good pricing is important. Buying the breakout, anticipating the move, and not reacting after they've already occurred is key to trading. And that's the difference between being long from the breakout area of that 913 to 920 versus being long from like a price of 950. The former is because you anticipated, the latter is because you reacted. Sorry, 1 second again, please. From Varun, can we talk about the risk with the Supreme Court on Friday. Are they opining on tariffs? So I think that the opinion on tariffs is due on Friday, but I don't necessarily think we get a decision on Friday. Someone please correct me if I'm wrong on that because I'm really not 100% sure. There absolutely is a risk here on the situation. Look, so this is what I think happens, right? I have no idea what the Supreme Court is going to decide, but last I saw, Polymarket, I think, was at an 80% that they're going to view the tariffs as illegal. So let's just present a couple situations that could happen and figure out what it'll most likely do to markets. Supreme Court decides that Trump can do what he's been doing. That's one option, and the market just stays the exact same status quo that it's been. Okay. Second option is the Supreme Court decides that the method of tariffs is illegal and cannot be continued. And then there's like a sub A and sub B to that. A is they can't continue to use that method of tariffing, but they do not have to pay back the tariffs that have already happened. Subpart B is it's viewed illegal, and they do have to pay back the tariffs that have already happened. In the first situation, the sub A situation, I also think it's kind of a non-event because the government they have other methods of implementing the exact same tariffs. So they're just going to not be able to continue the tariffs for a period of time, but very quickly he's going to be signing other executive orders or whatever where he's going to implement the exact same tariffs. He's just going to use a different way to go about it. So it ends up being a non-event. The bigger risk, which is a possibility, by the way, the bigger risk is if they view the tariffs, how they've been done, as illegal, and they have to pay back all the money that has come in so far. That, I think, is a disaster. I think it's a disaster for markets. And again, I am a very anti-tariff. I'm very pro-free trade. I'm very pro-competition and pro-capitalism person, which tariffs are the antithesis of all of that. So, they hinder growth, they increase inflation, they're attacks on the consumer, especially on the lower and middle classes. Yet, even with that being my thought process, I think it would be a disaster for the markets if the Supreme Court decides that we have to give back all of that money from tariffs, just because it's just going to be a cluster, bad word, of trying to figure out what money goes where, and people have already been selling their claims on that stuff, and at this point, a lot of that money, and look, the numbers that Donald Trump likes to say that the United States has brought in for tariffs are completely wrong. But I don't think I've ever seen him say an accurate number since he's been the president. He just exaggerates every number. The number is completely wrong. It's not the trillions and trillions of dollars that he has said, but it is a very sizable number, and a lot of that money has been earmarked already. And like I was just saying when we were reading the commentary that Trump just came out with about the increase in the military budget, we are increasing our budget while we are cutting taxes all over the place, which can only do one thing. It's going to balloon the debt in an insane way, and that's being done off the backs of these tariff numbers that are just being incorrectly stated by the administration. So, that money is already gone. We already see this calendar year that the debt is just further exploding. So I think it's a complete and utter disaster if they have to pay the money back, and the market probably gets crushed on it. And then they're just going to still move forward with bad tariffs anyway. They're just going to do a different way for it. So that's my thought process on the different potential situations and how they can play out. I think that 2 of the 3 situations are going to be relatively non-events. Maybe we get some volatility. One of the situations is a potential disaster. So, be prepared for it. I just don't know what the exact timing is. I think someone just said something about it here in the VTF on the timing, and I can't find it now. But anyway, let me try to find even where Varun's question was so I can go back to where I was. Oh, there it is. What to expect. The U.S. Supreme Court has designated Friday as an opinion day. Yeah, somebody, probably me, but it'd be better for somebody else, should do some real research on that and when we can expect to hear those things. All right, where was I? From Tim Q. Trading with my small account, I have a trade plan rule to not be adding to positions. Is there a situation where I can break that rule? No. If you have a rule, it's a rule. Rules are not meant to be broken. It's, in my opinion, is truly as simple as that. Rules are not meant to be broken, so don't break your rules. The question that you want to ask yourself is your rule correct? And if your rule requires some nuance. So, but if that's your rule, then don't break your rule. But the question is, are there types of trades and types of situations and types of game plans where you should be having a game plan that can enable you to add to positions and build into positions? And if the answer to that is yes, then you need to create rules around those game plans and around that thought process and around that math. And if the answer is no, then the answer is no. So that's how I would answer your question. From Robert, you mentioned the tape speed up in Intel through 44 and then sell back did not hold 44. Did you consider that speed up in tape as profit-taking action? I just considered it as capitulatory. That's like the final last leg a lot of times. What you're seeing in the tape again is the exact same thing that you can now see in hindsight in the chart, right? And as you know, like the upside capitulation hammer setup or the upside capitulation shooting star setup or the downside capitulation hammer setup. What you want to see from a volume perspective in those situations is maximizing volume at that technical charting signal, right? And this is just a little bit sloppy. What does a 15-minute chart look like? Yeah, it's a little bit sloppy with this kind of like hanging man doji that came in before the actual failure on the 15-minute. And on the 5-minute, you don't have like an upside tail, although I guess if you were to combine these two candles together, you'd get a little bit of an upside tail. But that's just kind of what you're just seeing in real time, right? If the tape is speeding up, that means that there is more rapid execution. That means there's increased volume. And a lot of time what that represents in a capitulatory type move is the last final chasing buyers coming in and the final people who have been short getting squeezed, and it's just a massive amount of volume. If you follow along regularly with the thing I do on Wednesdays with Sammy and JR, Sammy and I were talking recently, not in today's, but in one of the podcasts from the last couple weeks, about how you don't see those maximal volume capitulatory moves very much anymore in trading. That the robots or whoever have just gotten too smart and too sophisticated, and they don't really allow it to occur nearly as much as it used to. But it used to just be such a great go-to trading setup on multiple time frames to see the massive extension, maximizing volume, upside shooting star or downside hammer. And it would always play out that way with the tape really speeding up as that candle was kind of being built out. So today with Intel was a very similar situation. Not perfect, because you don't have that perfect executable shooting star candle here on a 5-minute chart or on a 15-minute chart, but the concept was there. And that's cool because we don't see that happen too much anymore. So I hope that helps, Robert. From Eli, when designing your models, systems, what was the biggest hurdle you ran into, and how did you come to realize that was the issue? It's a broad question, so it's a little bit tricky for me to answer. I feel like the gist of the question is in regards to the way that I trade a lot of stuff now, which is kind of like that cash flow strategy that I've spoken about so much, where bidding and offering on incremental amounts like 10 cents or 25 cents or 50 cents or $1 or what have you to make cash flow for myself while the broader trades are working out. The biggest hurdle I think I ran into earlier with that was modeling the risk of it, because like you've heard me talk about, it can be hard to have I up until I started implementing that kind of strategy, I always traded in such a way, which is what I usually preach to newer, more entry level traders to this day. I always traded in such a way where I knew the exact amount of dollars that I was risking on any trade before I got into it. And now it's not that way, honestly. When I'm putting on a trade, I sometimes don't know exactly how much I'm risking. I know roughly how much I'm probably risking in a given situation. Um, and the most difficult thing for me was, uh, probably just figuring out how to do that from a risk perspective properly, where I'm not being so tight on some of those increments where I can have so much size where I can just be getting absolutely and utterly destroyed on positions in a way that I can't afford, or not using like that hard stop loss, which at first I was trying to do this with like these very hard stop losses, and that really didn't work for me. So I think it was just a matter of kind of making the adjustments and focusing on the risk side of it, on sizing and spacing to be appropriate, to give me an understanding of just like the dollar risk that I'm risking versus the price and beta of the stock that I'm trading, if that kind of makes any sense. So like, very, very roughly, because this is not always the case, if it's a stock that's less than $25, then I'm probably looking at, if I'm implementing that strategy, doing it in like 10-cent increments. If it's a $25 to a $50 stock, I'm probably doing it in 25-cent increments. If it's a $50 to $100 stock, I'm probably doing it in 50-cent increments. If it's a 100 to 200, I'm probably doing it in dollar increments. If it's 200 plus, I'm probably doing it in $2 increments. But that's very, very roughly stated, because it definitely depends on the name, the situation, the game plan, the time frame, etc. So that was probably kind of, when building out what I do here, the more difficult thing to figure out. So hope that helps with your question, kind of an outside the box question. From Tim, I noticed traders here who are clearly pros with larger accounts start nibbling on trades and then add more when it goes against them. At what point is it enough? Is that a strategy I should learn right now with a small account? Let's take the Intel trade from today. How could I have traded that trade? I mean, so I don't. What is a small account is probably the first question I would ask, and that's a personal question. So don't answer that question publicly. But like what is a small account? Because and how much of that account are you willing to risk on an actual trade? And then it goes back to kind of at what increments are you willing to build in on. The problem, the wider the increments that you're willing to build in on, the less the overall risk. But at a certain point, they can become so wide that it just doesn't make any sense, because you're never going to be able to make any money because there's not enough movement for how wide you're trying to be on that trade. So, there's a couple ways to do it. I'm kind of just thinking out loud as I'm talking here on your question. But so let me go back in my brain to when I was a new trader with a small account. I started with $5,000 in my account. We don't even accept traders anymore with $5,000. It's below our firm minimum. But back in 2010, when I started with T3, $5,000 was the minimum for a prop trader, and I started with $5,000. And I would implement a system of building in front of a stop loss, but it's still just based on the math. So the bottom line is it's all based on the math. So like, I remember a very common thing that I would do is let's just say I was going to go short versus $20, and I might short 400 shares at $13.88, 400 shares at $13.93, and 400 shares at $13.97. So I would end up with a total of 1,200 shares if all three got filled, with the stop loss, like I said, at $20. So how much risk is that? 400 shares on 12 cents risk is $48. 400 shares on, what did I say, 92? 8 cents risk is $32. And then 400 shares on 3 cents risk is $12. So what is that total? Like $75, something like that. So you can be a small account trader and have a system where you build in versus a stop loss to give your trade a little bit of room, and still be a small trader and risk, like in the example I just gave, $100. It's just all based on like this is the biggest thing. It's all about game planning math, and I think you're newer here on the team. So you probably haven't heard me say something that I've said before many times, which is, first of all, I think that the math behind game planning and trading is more important than your knowledge on technical analysis. And secondly, a big thing that I used to do when I was a newer trader, which was massively beneficial in my trading career, and I probably wouldn't be here today otherwise, is on the weekend, really on Friday night after I would finish sparring, back when I fought professionally, Friday night was always our big sparring night. After sparring, especially when I was in training camp, if I wasn't in training camp, I might grab a beer. If I was in training camp, then I wouldn't have a beer. But either way, it'd be Friday at 9-10 p.m. and I would turn the computer on, open up a blank spreadsheet, and I would just start playing with game plans, exactly like I just described. If I short 400 shares at 88 cents, 400 shares at 93 cents, and 400 shares at 97 cents with the stop loss at the figure, the whole number, how much am I risking in that game plan? Well, what if it's a $200 stock and I short 100 shares on a dollar away from my stop loss, and another 100 shares, or maybe I short 200 shares at 50 cents away from my stop loss, and they short 400 shares at 25 cents away from my stop loss. In that trade, in that example, I'm risking $300. So it starts with like, what is your scale of risk based on your account size? And by the way, this is true whether you have a small account or a large account. That doesn't really matter. You start with, what is my scale of risk? Scale of risk means risk skew on my account, meaning on an average, on a trade for me, based on my account, I'm willing to risk anywhere between $50 on a trade I don't love, but it's worth taking, all the way up to $300 on a trade that I love that's really worth taking. And honestly, those numbers I just mentioned should be appropriate for literally any trader that's part of our team, even if you have the smallest account possible with T3. And then once you have those numbers in place, you say, okay, in a situation where I'm going to risk $200 in a trade, how can I divide that up into entries versus a stop loss? And then when your trade presents itself, any trade by definition has to have a reason for entry and a place where you're going to take your loss, or a method of taking your loss. Once you have the reason for entry and the method for taking loss, or for most people that just means stop loss, then you can figure out what the method of entry looks like in terms of how you're dividing up that risk. Some trades, like momentum style trades, breakout trades, things like that, oftentimes it makes more sense just to take all your stock at once. Other trades, if you're buying off support or something like that, then it's going to make more sense to maybe have a little bit more of a build-in process versus that support level. But either way, and again, it's regardless of account size, you want to be just understanding all of your game planning and math on all of different possibilities on how you can take XYZ dollars worth of risk and then divide that up into how you're going to implement the trade. And I think that's the bottom line of your question. From Eddie, is there any specific reason you prefer the 8 EMA than like the 9 EMA? Sure. So that's an interesting question. So generally speaking, I'm a big believer that any and everything that you do in your trading should be having a strong reason behind it. And I get this question every once in a while that you're asking, and the truth of the matter is, this is the one thing where I don't have a strong reason behind it. When I was a brand new trader 15, 16 years ago at T3, and the trader who at that time was responsible for helping me with my trading software layout put an 8 and 21 on my charts. And that's what every other trader on the team of traders that I worked with at that time when I was a new trader also had on their charts. And that was it. And then the methodology though in which I use an 8 and 21 EMA that you hear me talk about that works so well for me in terms of the space between the 8 and 21 EMA acting as technical equilibrium, that's unique to me. I haven't found any other resource or any other trader that discusses using an 8 and 21 EMA in that way. That was something I just kind of came up with and figured out purely on my own through my own trading. I didn't learn it from anyone, and I just learned it entirely from myself. But 8 EMA versus 9 EMA, tomato, I honestly don't think it matters that much. It's just going to be more your conceptual understanding of it. So let's answer the question. From Kevin, I got long Roku today. I got long Roku today from very close to the daily 21 EMA. Okay, so what I would classify as the lower band of equilibrium, which is at 108.56. Thoughts on bounce trading this dip, looking for an extension of the prior high. Roku is down big today on no news that I could find. When initiating a swing trade, do you ever look at PC, open interest ratio? What is PC? Price to something? What is C? You gotta remind me. Put call ratio. Oh, got you. When initiating a swing trade, do you ever look at the put call open interest ratio on the stock's option chain? I probably should have read the rest of what you said. I would have known what PC means. What does it mean if the put call in a series is close to 0? More calls or above 1, more puts. Does it affect positioning? How should I interpret it? I see some decent put buying in the monthly options for Roku. Today is my first day trading live at T3. Thanks. Okay, well, welcome to your first day trading live. All right, so one thing at a time. Feedback on the trade. It looks like it worked for you. I'm glad for that. I got to tell you, I don't love it. I don't love that this thing just now had a failed breakout, got back below 112, lost yesterday's low, gave an inside and down, and for some reason was acting very, very relatively weak. I don't like that. It did manage to hold that lower band of equilibrium. It did manage to hold kind of its next level of support, which is at 108, and then it rounded up a little bit for you, so hopefully you got decent price and decent profit cushion if you're swinging the position. But for me personally, the first day that this is failing back through a previous resistance level is not going to be the day that I'm coming in and buying it, especially when it's relatively weak. So personally, I don't love it, but it did tail back up by the end of the day, and if you can get this thing to recapture 112 relatively quickly, then it'll start looking a lot better again. So going back to what I was saying yesterday about swing trading and trying to put yourself in a win-win situation, if you have a good profit cushion and you're in that win-win situation, you're keeping some stock overnight, fine. In regards to the second part of your question, I don't look at put-call ratios on my trading. I don't, and I don't have strong feedback for you on it. Occasionally, I will note from sell-side research reports that we get access to that can be in Pat's notes when the market-wide put-call ratio is hitting an extreme, because when it is at an extreme, it can be, I'll call it a contrary layer of probability for the other side of the market. I'm specifically using that term, and I'm not saying an indicator. I wouldn't classify it As an indicator, I would classify it as a piece of information, and pieces of information I classify as layers of probability. So when I'm reading sell-side research that is letting me know that at the index level we are very extreme on one side or the other, again, that becomes a contrary indicator. Nope, I just used the word I said I wasn't going to use. That's a contrary layer of probability that if I'm long and it's getting extreme, that I should be selling extra stock or looking short or the opposite. And I don't pull it up or look at that information at all on the individual stocks that I'm looking at. But again, there are ratios, and you can do your research on it. I don't know them off the top of my head, where at certain amounts of ratios it becomes extreme enough that it can act again as that contrary type of layer of probability or signaling mechanism. What I do pay attention to is consistent large order option flow. Because of its ability to create gamma squeezes in the market. So when you've got really consistent large order option flow that's coming in, usually it's like repeat large calls going off over and over and over again in a stock or in the market. Who's on the other side of those is market makers, and the market maker has to come in and hedge themselves by buying the underlying stock, and that creates a gamma squeeze in the direction of the repeat call or repeat put buying that you're seeing. So that I pay attention to. It goes back to something you're going to hear me say all the time, which is don't fight the flow. I don't want to be fighting the flow of very consistent large order option flow on trades that I'm looking at. I want to be going with that because it can get so big sometimes it becomes a self-fulfilling mechanism. So hope that helps, Kevin. If there's an inside bar tomorrow, I might double or triple my position. My size is small. Also, a fib cluster near the 21 EMA. Okay. Index level put call extremes are important market internal. Sometimes for retail stock option sentiment. Yeah, exactly. Basically controls the stock with gamma levels. Yep. Yeah, exactly. From Bill K. The U.S. Supreme Court set Friday as an opinion day, raising expectations that the court could rule on the case regarding global tariffs President Donald Trump imposed using the International Emergency Economic Powers Act. I've seen talk about hedging Friday, but just an assumption that ruling comes. Thank you, Bill. From Jackie, can you talk about how you game plan on the fly for names that you end up trading that aren't part of your morning game plan? Sure. I would say that at this point, I have almost like a whole series of preset game plans that I apply on trades. So for me, if I see a trading opportunity that I want to be involved in, it's not at this point a matter of me building out a whole game plan for that. It's a matter of me saying which of my game plans that I already have in hand, because I use them over and over and over again, is best fit for the trade that I'm looking at. And therefore, it just becomes significantly easier for me to be able to do that. So that I can just do it very quickly on the fly. I'm looking at, all of the factors of that trade, the price of the stock, what type of trade is it? Is it with trend? Is it counter trend? Is it a momentum trade? I'm looking at all of those factors, and then I'm saying, all right, I think that this one of these game plans that I use regularly is the appropriate game plan for all of these factors for these trades, and then I put it on. And at this point, that's so ingrained in my brain that that entire process takes, honestly, like seconds for me to say, all right, this is the trade, this is the game plan, I'm in. From Show, please share your thoughts on Amazon swing long with large upside tail today. What is the probability to continue with the upside, or would you wait and see tomorrow? Yeah, probably let's just continue to watch this one. You have a little bit of an upside tail there, but that's probably because of the market more than anything else, and the stock was pretty extended. Even at highs here, it's pretty extended. So I'm still on Amazon. I still like it. So I think that you can stick with the trade. If at this point it's so extended, that's the only problem is that you really have to give it all the way back to like 433 still. If it gets below 433, your trade's probably wrong. But we need like a bull flag, or we just need more time here. We need a bull flag, we need a pivot low, a pullback pivot low, or further momentum continuation to kind of garner more information. Just reading Emily and Tim's comments. All right, cool. So I got through everything on the VTF. Let me pop over to the YouTube for sure. From Scott, out of my WDC short from yesterday, I made a good profit, but not without a cold sweat. Yep. Palantir's moving on the news. From Chi, can you give us your thoughts on retail crowd using long calls to drive Momo, and them flipping to long puts in the same way, squeezing gamma in the other direction? I don't think that they're sophisticated enough to do that as a one cohesive retail group where they are using long calls to drive momentum and then flip to long puts. I do think that at least part of what you're saying is very accurate, though. You know, when you think about the Wall Street Bets crowd and the way that they can use modern communication to work together and pool their money together, you definitely see, you know, just look at like how RGTI was trading in October when it peaked out. And when the meme names all start running together like they did, you know, we had a mini bubble in meme stocks in October. Not as crazy as late 2020, early 2021. We had a mini bubble, and that's exactly what was ongoing at that time. It was just the retail crowd buying up those long calls and creating the gamma squeezes that are driving the momentum. But then I don't think that what caused the top in RGTI was them being so smart that they said, all right, we made all of our money long. Now it's time for us to flip to long puts and make all our money short. I think it's that they were actually continuing to buy them, but it hit a point where enough other smart money was able to come in and say that this is ridiculous, that it was able to eventually overwhelm the momentum gamma squeezes that were coming in. At the same time, some smarter retail people probably profit taking at the same time, and then all of a sudden it breaks them. And I think that instead what's happening is the last leg of those momentum chasers from the retail world actually gets super burned in the upside of that move. That's what I think is actually occurring. So, you know, I think that you're definitely seeing, you know, option flow creating those squeezes from the retail world. It's part of the market environment now, but I think it just eventually hits a point where it what does Miguel get say onto those up moves? I can't remember. It blows up on its own delta or something. He's got a cool saying about it. Where's Bill K when I need him? Anyway, my brain's starting to get tired too. From Giancarlo, do you think the weakness today is related to the courts? It could be that caused us to fail. I didn't read the question fully out loud. Related to court's upcoming decision on tariffs. Yeah, it definitely could be. What are your thoughts on that? I believe Polymarket has 30% that they uphold. Does that concern you? Cool. I think we answered that one already. Someone in the VTF asked a very similar question, so I think that one's already been answered. From Alcor, thoughts on silver. Thoughts on silver. I'm still short silver. I've done very, very well with this trade, but it has not been an easy trade because the two best shorts, I guess actually there's been three pretty good shorts with gap downs at this point, but the two best ones required you to hold it short when it closed on highs, and that's very difficult to do. And I did it twice, and this was the heaviest that I was, and this was the second heaviest that I was, and then just dumped a lot of the position into the ADMA. What are my thoughts on the trade? So, the first thing I would say is that I think that there's actually something structurally occurring in the metals that is creating this phenomenon to the upside. And it's coming from a couple different places. It's coming from all the geopolitical tensions that's going on right now globally. China, Taiwan, Russia, Ukraine, United States, Venezuela, all three of those stories in some way are like the same story. It's coming from a bid that's coming from a reflation trade. I think that this market's actually still scared of inflation, especially when you talk about the Fed cutting interest rates in a environment now where we are pretty much at the neutral rate, I think. So if we start cutting rates heavily here, you're going into some serious easing. And there was a whole thing about Moran at the Fed, who is like, you know, someone in there to do Trump's bidding, as the next Fed chair will be the same, wanting another 100 basis points of cuts in 2026. I don't see how 100 basis points of cuts in 2026, if it were to happen, which that's not what the market's pricing, but that's what Trump certainly wants. Trump wants even more than that. I don't see how that doesn't create huge inflation. At the same time, I know that the dollar has improved a little bit, but the dollar, I mean, 2025 was one of the worst years in the history of the dollar. So all that's coming together to create a structural shift that is causing silver and gold and platinum to do what they're doing. The really interesting thing, not to get off tangent, is how crappy crypto is. So, you know, for a minute there, I thought that Bitcoin could truly be being a digital gold, and now I'm right back to crypto is completely and utterly worthless. So all these things are happening at once, where there are a lot of people on two different sides of this metal trade right now. Some of them think that this is just the beginning of a move that's actually going to become significantly more parabolic. Some people think that the mercantile exchange is going to, you know, further increase the rules on leverage and money. What's the word I'm looking for? That's going to cause this to implode upon itself, and that you're going to get like a really, really big down day at some point soon. I am very much in the middle of those two arguments personally, and I could really see either of them happening at this point. So for me personally, I kind of see silver, which I'm short, as a little bit of a coin toss. I could see this thing continuing this trend and like really actually increasing in a much, much more significant way the parabolic nature of the up move in the metals. I could really truly see that happening. You know, more similar. I know Rock on the VTF keeps bringing up this 2011 move. Let's take a look at that. How do I zoom? This 2011 move, like the degree of the parabolic nature of this 2011 move, is way crazier actually than what we've seen so far with this move. Even though it obviously did eventually implode upon itself, but this portion of it, like I feel like if I could overlay these charts, we would actually only be somewhere around here. So I could really see both sides of that happening. I could really see this thing actually squeezing to SLB $100. But I could also see that other situation where this move has gone parabolic enough, and they increase the mercantile exchange increases the word that I'm not remembering, that requires people to, you know, liquidate some of their silver leverage, and you get the big fast drop down in this thing really quickly back to the low 60s. I could really see both of those situations occurring. For me, it's been a trade that I've been really massaging into the points of more extreme extension, and I have honestly been very, very conservative on those pullbacks. Like, again, liquidating 80+% of my position by this low and keeping a little bit for a little bit of a deeper move that didn't happen. And then it was kind of the same thing here. I was even lighter by the 31st. And then, you know, slowly increasing my size to the point where yesterday I got heavy again in silver, but I probably still at yesterday's high had half of what I had on the 26th. With that said, you may have heard me say I lost sleep this weekend over how much size I had on the 26th, and I didn't want to put myself in that situation again. And it worked out great, but I you know, it kind of ruined my weekend, and I don't like that. I've actually been actively paring down my P&L swings from where they were at certain points in 2025, which were just too crazy. So yesterday it was like starting to feel a little bit uncomfortable with the amount of size I had with us closing at highs and continuing to 75 after hours, but nothing like the size that I had here. It's probably 50% of the size. And the same thing. At lows today, I was probably at 80% of the position, and now I'm back where I've got a little bit of stock on here, but it's nothing that I'm uncomfortable with at this point. If we were to gap up 10% tomorrow, even, which I don't think is going to happen. So I'm really massaging this trade, and I'm reducing size through both time and price. When I get the pullbacks, I'm heavily reducing size. It's a game plan I have built out, but I've also been reducing size through time. Like even today, as this day went by the close at $71, I had less stock than I had at $71 at 11:30 because I'm massaging out of the position through both time and through price. Because again, circling back to what I was saying before, I could really see these things going in both ways from here. I don't have strong conviction in one side or the other, and I'm trying to recognize that with the trade that I'm actually putting on. And I don't want to be stubborn because I think like this is a crazy move or whatever, and it's going to go back down to $50 and it's a parabolic move. It could go to 100 first. So that's really kind of my thoughts on it. I know it probably doesn't give you the perfect answer that you want because I'm not giving you really strong conviction here. I'm literally saying it's a coin toss on parabolic continuation to 100 versus heavy drop down to 50. But that's kind of how I've been trading it because that's what my thought process is. From Alcor was seeing speculation that index funds are going to have to sell gold, silver the next few weeks. Wondering if that's likely to dampen this trend in gold, silver. I haven't seen that, but of course, if there's forced selling, which that's definitely what the bears have been pointing to, is that you're going to get forced selling at a certain point, then yeah, that's what you're going to see. From Greg, just read Rubner's note from yesterday, which I haven't read yet. I've read a couple excerpts from it. Last note, interesting and may represent literally everyone's thinking on a macro level. Looking ahead, we expect some healthy digestion in February as earlier allocations normalize and volatility has scope to reprice. Any pullback or vol reset would represent an opportunity to re-engage risk at more attractive levels. For example, any further pull and vol from here should be bought to protect against February downside. It's just never that clean, in my opinion. We all seem to have the same idea. Wait for new all-time highs and get shorter hedge downside, which is interesting. Yeah, and it's kind of where my head's at too. Honestly, the closer, the more time that goes by right now. So like, I look at markets in at this point I would say two main ways, right? I look at them through the lens of strict technical analysis and charting, and I also try to look at them through the lens of like market dynamics, let's just say, which is very broadly based. And from a market dynamic perspective, the more time that goes by here in the beginning of this new year, the less bullish I am. And I'm trying to keep that in my brain as I judge the technicals, which are still bullish, and the market dynamics, which at this point are also still bullish. So that's why I've really been trying to lean towards the bull thought process here, through starting really at that midpoint in December through now, and it's worked out pretty well for me. But at the same time, I'm still keeping some shorts on, especially some of my legacy shorts that I've got good profit on. That fine, let them run back against me a little bit and land back into them and continue to manage the positions. And I'm also really today actually was the first time that I thought I started to think about it, and it's probably a little bit early still, I think. But I was listening to, really, it was because of Pat, when Pat started posting that Bank of America indicator that's on the extreme side now, which indicates that selling might come in, and you keep hearing Pat say that positioning is getting full. Everything I'm reading says that positioning is getting full also, but isn't really there yet, and there's still a bid to the market. But then the way Pat was talking and the way he showed that indicator in my brain, I was like, all right, I know that through time, I'm planning on losing some of my bullishness, but for the moment, I want to be bullish, especially while the technicals confirm it. But maybe I should now be starting to slowly think about not re-engaging my longs in the same way that I had been kind of previously over the course of the last few weeks, not re-engaging them as aggressively. And that's kind of where my head's at. But at the same time, I'm also not ready to really be hammering the shorts. I'm keeping the shorts and I'm trading some things to the short side. And I've got this like SOXL short, which has been a little bit of a headache, honestly, though I finished with good P&L on it today. It's my best name today. That's kind of where my head's at in terms of like a bigger picture management of the portfolio, while obviously on a day-to-day basis, intraday, I'm just trying to pull cash out. But again, it's the bigger picture moves and getting the bigger picture right that I think breeds the bigger P&L. And it's the in-between is how you make a living, but it's the bigger picture stuff that is how you do really well. So that's kind of how my head's working in terms of like big picture and small picture management at the same time, and time moving on. And like I think we're gonna have a volatile year, and I think that we're gonna see. It's not a big call out, but we'll see a 10% correction this year. The bigger call out is I actually think that we might see two 10% corrections this year. I think we might have a volatile year. And again, I think that the combination of technicals and market dynamics will point to the timing of that. And it's going to be on us to make sure that we are on the right side of each side of those movements and of the larger movements when they present themselves. Whew. All right, I'm shot. I'm done. That was a lot of talking. You guys are really making me use my brain, and I'm beat. So I'm going to wrap it up there. Have a great night, everybody. See you tomorrow.